You need to pay very close attention to what is happening right now, because what we are witnessing in Bitcoin is not a normal market fluctuation. It is the kind of movement that historically appears only when pressure has been building beneath the surface for a long time. Only a few months ago, Bitcoin surged above $120,000, a level that many believed confirmed the continuation of a powerful bull cycle. Liquidity was abundant, optimism was everywhere, and capital was flowing rapidly through exchanges, ETFs, and institutional channels. And yet, almost silently, the structure beneath that rally began to weaken. You can see the first warning signs if you look carefully. Trading volume exploded during the peak months, but volume alone does not tell the full story. What matters is the quality of liquidity, and what we began to observe was a shift from long-term positioning to short-term speculation. This pattern has appeared before in financial history. In the late stages of many market cycles, whether in commodities, equities, or currencies, you often see large price swings combined with declining conviction. It's not the absence of buyers that triggers instability. It is the change in the type of buyers. Then the market began to fracture. Prices did not collapse in a single dramatic crash. Instead, they slipped, stabilized, slipped again, and each recovery became weaker than the one before. This is what professionals sometimes call a distribution phase. It happened in the dot-com cycle. It happened in parts of the housing market before 2008. And now we are seeing similar structural behavior in digital assets. When Bitcoin fell toward the $70,000 region, many people focused only on the price itself. But the real story was the speed of capital withdrawal and the hesitation that began to spread across the system. Now I want you to consider the deeper forces at work. Markets do not move in isolation. Bitcoin is often described as independent from traditional finance, but capital flows are never independent. Interest rate expectations, dollar strength, global risk appetite, and sovereign debt pressures all shape the environment in which speculative assets operate. Over the past months, real yields remained elevated, and global liquidity conditions tightened compared to the expansionary periods that previously fueled explosive rallies. When liquidity contracts, the most volatile assets are always the first to feel the strain. At the same time, something else began to happen, something quieter but equally important. The mining sector, which forms the backbone of the network, started showing signs of stress. Rising energy costs, operational pressure, and declining margins forced weaker participants to step aside. Historically, minor capitulation phases often coincide with transitional moments in the market cycle. This does not always mean immediate collapse, but it does signal that the internal equilibrium of the system is shifting. And then came the global acknowledgement, the moment when the broader financial world began to react. Regulatory discussions intensified. Central bank watchers began to include digital assets in broader liquidity analysis, and large financial institutions started adjusting their exposure models. This is not the kind of attention that accompanies a stable, predictable environment. It is the kind of attention that emerges when volatility begins to threaten interconnected markets. But here is where the contradiction becomes clear. Despite political rhetoric that appeared supportive of the crypto sector, and despite conferences, institutional panels, and public statements projecting confidence, the market itself did not behave with confidence. Prices hesitated, rallies faded quickly, and volatility remained elevated. This divergence between narrative and price action is one of the oldest warning signals in financial history. When optimism remains loud but price action weakens, it often means that underlying structural forces are stronger than public perception. So, what does all of this mean? It means that what you are seeing is not just a correction and not simply a headline-driven reaction. You are witnessing a phase in which liquidity, psychology, and structural pressures are colliding at the same time. Markets rarely move in straight lines, but they do leave footprints, and right now those footprints are signaling that the system is adjusting to a new equilibrium. The question is not whether volatility will continue. Volatility is already here. The real question, the one that serious analysts around the world are asking, is whether this moment represents the end of a cycle or the beginning of something far larger that has not yet fully revealed itself. You need to understand something that many people in the market overlook, and I want you to listen carefully, because this is where the real story begins. Not on the price chart, not in headlines, but deep inside the machinery that keeps the Bitcoin network alive. While most investors were watching candles on a screen, the infrastructure itself began to send warning signals, quiet at first, then impossible to ignore. Mining difficulty does not fall dramatically without a reason. When difficulty dropped sharply in early February, it was not just a technical adjustment, it was the market revealing stress in its most fundamental layer. Mining is not speculation. Mining is a business built on electricity costs, hardware depreciation, financing rates, and operational efficiency. When margins compress, weaker operators are forced to shut down or liquidate reserves. That process does not happen overnight. It builds gradually, and by the time the data confirms it, the pressure has already been accumulating for months. You have to see this in the context of broader economic reality. Energy prices across many regions remained elevated compared to historical averages. Borrowing costs stayed high, and capital became more selective. In macroeconomics, we often talk about the cost of capital as the invisible gravity that shapes markets. When capital is cheap, risk expands everywhere. When capital becomes expensive, the system starts shedding its weakest components. This is exactly what we are seeing now. Miners operating on thin margins were the first to feel the weight, and this is not new. If you look back to 2021, after major regulatory actions forced large mining operations to shut down in parts of Asia, the network experienced a similar difficulty collapse. At that time, the system eventually stabilized, but the adjustment period was volatile and unpredictable. History does not repeat perfectly, but it often rhymes, and right now, the echoes are unmistakable. Another signal appeared in block times. When block intervals stretch and adjustments become necessary, it means the rhythm of the network itself is being disrupted. Think about that for a moment. Bitcoin is designed to function like a clock, precise and predictable. When the rhythm changes, even temporarily, it tells you that the participants sustaining that rhythm are under pressure. That pressure eventually translates into market behavior, because miners are not just securing the network, they're also one of the largest consistent sources of supply. This is where the real mechanics of the market become visible. When miners are forced to sell reserves to cover costs, it increases supply at moments when demand is already fragile. In macro terms, this is similar to what happens in commodity markets during downturns. Oil producers, for example, sometimes increase production during periods of falling prices, not because they want to, but because they must generate cash flow to survive. The result is a feedback loop that accelerates volatility. But I want you to notice something important here, something that many commentators miss. A difficulty drop can also be a cleansing phase. When inefficient participants exit, the network becomes more sustainable for those who remain. We have seen this pattern in multiple cycles across different industries. After the railroad boom of the 19th century, after the telecom bubble in the early 2000s, and after the global financial crisis, weaker firms disappeared and stronger structures emerged. Painful transitions often lay the groundwork for the next phase of stability. And yet, this is where the contradiction becomes visible again. While these structural adjustments were unfolding, public narratives continued to focus on price targets, short-term predictions, and speculative enthusiasm. There is always a delay between structural change and public awareness. By the time everyone understands what is happening, the critical phase has usually already passed. So, I want you to think about what this really means. What we are witnessing is not just volatility. It is a rebalancing of the internal forces that sustain the system. Liquidity, operational cost, and market psychology are converging in a way that forces the network to adapt. These are the moments when markets decide which participants remain and which disappear. And if you step back and look at the bigger picture, you begin to realize something that experienced observers understand well. The most important signals in any financial system rarely come from the loudest headlines. They come from subtle shifts in structure, from pressure building in places most people never look. Right now, those shifts are happening in plain sight, and the implications of what is unfolding beneath the surface may take months or even years for the broader public to fully understand. Now, I want you to step back for a moment and look beyond charts, beyond miners, beyond the day-to-day volatility, because the forces shaping this market right now are not only technical or internal, they are political, institutional, and deeply tied to the structure of the global financial system. And this is where things become more serious, because when governments and central banks begin adjusting their posture toward an asset class, history shows that the consequences rarely remain confined to that asset alone. Over the past months, you may have noticed an unusual pattern. On one hand, public statements in several major economies sounded supportive of digital assets. Regulatory frameworks were discussed, stablecoin structures were outlined, and policymakers spoke about integration rather than prohibition. At first glance, this looked like a green light, and many people assumed it would remove uncertainty. But markets do not respond only to words. They respond to clarity. And what we are seeing now is not clarity, but transition. You have to understand how regulation affects markets at a structural level. When new rules are introduced, capital pauses. Institutions do not move quickly in uncertain legal environments. Compliance departments, legal teams, and risk committees slow everything down. This phenomenon is well known in macroeconomics. It happens in banking reforms, in energy policy, and in currency markets. Even supportive regulation can temporarily reduce liquidity because participants wait to see how the framework will actually function in practice. And while this process was unfolding, expectations about monetary policy were shifting at the same time. Real interest rates remained elevated compared to the ultra-low levels that fueled previous speculative cycles. When real yields are high, capital has alternatives. Treasury markets, corporate bonds, and money market instruments begin competing more effectively with risk assets. This is not speculation. This is a structural relationship that has existed for decades. The higher the real yield environment, the more pressure speculative assets face in attracting large patient capital. I want you to remember what happened in previous cycles. In the early 1980s, when Paul Volcker's Federal Reserve pushed real rates sharply higher, entire sectors of the financial system went through painful adjustments. In 2018, when global liquidity tightened and the dollar strengthened, emerging markets and cryptocurrencies both experienced significant stress. Liquidity is the oxygen of markets, and when that oxygen becomes thinner, even strong structures begin to feel the strain. At the same time, institutional involvement in digital assets has reached a level that did not exist in earlier years. Pension funds, asset managers, and large trading desks now monitor Bitcoin not as a curiosity, but as part of a broader portfolio framework. That means correlations matter more than ever. When global risk appetite falls, digital assets are no longer isolated. They move with the tide of global capital. This is the price of legitimacy. Integration into the financial system brings stability in the long run, but in the short term, it also brings exposure to global shocks. And here is where the contradiction becomes impossible to ignore. The narrative surrounding digital assets continues to emphasize independence from traditional finance. Yet price behavior increasingly reflects the same macro forces that move equities, commodities, and currencies. This tension between ideology and reality is one of the defining characteristics of this phase of the market. You can also see the growing attention from central banks and financial authorities, not in dramatic announcements, but in subtle signals, research papers, speeches, regulatory consultations, and discussions about systemic risk. These are not random developments. They are signs that digital assets are no longer peripheral. When a market becomes large enough to influence liquidity conditions, payment systems, or investor behavior, it inevitably becomes part of the broader policy conversation. So I want you to think carefully about what this means. What we are witnessing is not simply a volatile asset experiencing a correction. We are watching an asset class being absorbed slowly and unevenly into the architecture of global finance. That process is never smooth. It creates uncertainty, hesitation, and periods of sharp repricing. And right now, as you watch these movements unfold, what you are really seeing is a system in transition, a moment when policy, capital flows, and market psychology are all adjusting at the same time. These are the moments that years later, analysts point to and say, that was the turning point. The period when the structure of the market began to change in ways most people did not yet fully understand. Now I want you to take a deep breath and look at the full picture, because what is happening right now is not just a sequence of events, it is a convergence. Price volatility, mining stress, regulatory transition, and shifting liquidity conditions are all unfolding at the same time. And when multiple structural forces align like this, history shows us that markets rarely remain unchanged afterward. These are the moments that define entire cycles. You have to understand how financial cycles work. Every major asset class, whether it was gold in the 1970s, technology stocks in the late 1990s, or housing in the mid-2000s, moved through recognizable phases: expansion, euphoria, distribution, and repricing. But the most important phase is always the transition, the period when the market stops behaving the way people expect. That is the phase we are entering now. The signals are not loud, but they are consistent, and consistency is what experienced observers watch for. Look at the way expectations are forming. Short-term forecasts are beginning to cluster around modest recoveries, stabilization zones, and gradual shifts rather than explosive rallies. That alone tells you something important about psychology. Markets driven purely by speculative momentum talk about unlimited upside. Markets entering structural adjustment begin to talk about balance, sustainability, and consolidation. Language changes before reality fully changes, and that shift in language is already visible. At the same time, global capital flows are quietly reorganizing. Large institutions move slowly, but when they move with intention. Risk models are being recalibrated, exposure levels are being reviewed, and correlations with traditional markets are being measured more carefully than ever before. These processes are not dramatic, but they are powerful. In macroeconomics, the biggest shifts often occur not through sudden decisions, but through gradual reallocations that accumulate over months. You can also see this moment reflected in industry behavior. Conferences, policy discussions, and technical forums are no longer dominated by speculative enthusiasm alone. The conversations have become more serious, more technical, more focused on infrastructure, regulation, and long-term integration. That change in tone matters. It is similar to what happened in the internet industry after the dot-com crash, when the focus shifted from rapid expansion to sustainable growth and real-world application. The noise faded and the foundation strengthened. But there is still tension in the system, and you can feel it. Markets are searching for equilibrium, and equilibrium is never reached smoothly. Volatility is the mechanism through which markets discover price, and discovery can be uncomfortable. That is why you continue to see sharp moves in both directions. Sudden bursts of optimism followed by hesitation. These are not random fluctuations. They are the signs of a market trying to find a new balance between liquidity, regulation, and real economic conditions. And here's the part I want you to understand most clearly. Turning points are rarely recognized in real time. When the Bretton Woods system began to unravel in the early 1970s, very few people understood what they were witnessing. When the global financial system began to fracture in 2007, most headlines still spoke of stability. It is only later, when the data is complete and the story is clear, that people realize they were standing in the middle of a historical transition. Right now, you are standing in one of those moments, not necessarily the end of something, and not necessarily the beginning of a collapse, but a shift, a structural adjustment that could shape how digital assets interact with the global financial system for years to come. The market is not sending one signal. It is sending many signals at once, and together they form a pattern that experienced analysts recognize immediately. So, as you watch the charts, as you follow the news, as you hear the debates and the predictions, remember this: the most important developments in financial history often unfold quietly, beneath the surface, long before they become obvious to everyone. What we are witnessing now may not yet have a final name, and its full consequences may not be visible today. But the direction of change is already underway, and the system is already adapting. The only question that remains is how far this transition will go, and how different the financial landscape will look once it is complete.